Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And in this particular case, it's the markets that move the markets because we're watching some market movement take place this particular week.
Which is what we talked about last week.
We sure did. And we're definitely seeing it play out the way we were hoping it would.
Yep. And I think both of us are parking money for our clients in anticipation of what we're seeing now. Now, tell us what we just broke through. We hit a Fibonacci number today. Tell us what that was.
Sure. So I know we were talking about this before recording in. I would like to say it makes both of us very uncomfortable when we've got money, we're ready to go into precious metals, that we're not putting into precious metals.
You've got your mom's money. You've got your mom's money.
I know. Don't tell her.
waiting
yeah,
to
so
buy.
there is, Kevin made his joke about his P wave, right? Because we're going to talk about some Elliott wave today. Your A wave, your B wave, your C wave, your D wave. And Kevin's got the P wave, the protection wave, which is the main reason you should be owning precious metals.
Right.
But there are some people out there who already have a pretty significant precious metals position and may be looking for opportunities to piece into it over a period of time, and as we're seeing these drawdowns, and that's why we like to talk about these drawdowns. We had 12 of 14 straight weeks where gold finished the week up. We went up over $300 since November. It's good to see a little bit of a drawdown here, but where are we going to draw down to?
We're almost there, in my opinion. What was the Fibonacci number we touched today?
Sure. So we hit the 382 fib today. If you look at the start of this rise back at around 1630, which occurred at the beginning of November, and the finish here about a week ago at 1960-ish, your 382 fib lands us right at about 1833, which is where we're at now.
All right. How much longer are we going to be down here? And this gets to my issue. I was up cleaning the horse stalls the other day with quite a bit of money on the sidelines for my clients. And we are within 2% of what I think will be the bottom, if not the bottom, darn close. And I thought about it. I'm like, don't get too cute with these folks' money, because they're not buying gold based on price action. They're not here trying to swing for the fences. They want to protect this money.
That preservation wave,
yes.
The P wave.
Right. It puts a lot of pressure on us. So I've been dollar cost averaging with my clients.
Right.
That's the
I
only
know
way
we talked about silver for your client last week.
Yeah. It's the only way to do this. But I don't expect that we're going to be here for very long, because seasonally, the metals, especially these last few years, have had their strongest move in the spring. And we are almost coming into the spring market for gold. So tell us where you anticipate this coming to, best guess, plus minus, and then where we can anticipate the next up leg taking us by spring.
We went into this a little bit last week, so I'm going to bring a couple things back out. I want to look at the 200-day moving average, and I do want to look at some of these fib retracement levels. So we've come into the 382 at this point as of today. I wouldn't be surprised to see either a little bit of a bounce over the rest of this week, maybe into next week. Maybe we jump up $20-$30 before we come down, or we could wake up tomorrow and gold's down $40 by the time this show goes live. So what I'm looking for and what I think is going to happen over the next week or two is I think we're going to come together between about the 50% line and the 200-day moving average.
Okay.
I think those two prices, as the time goes on, the 200-day keeps resetting itself, and we're above the 200-day. So the 200-day is rising as we speak. And it's just below the 50% line now. So by the time we get there, I think we're going to see two major indicators cross right as we reach that price. That means you've got two sets of traders. You've got Fibonacci traders and you've got moving average traders that are both going to place bets at that price. And I like it when you have multiple indicators lining up at the same place, because I know that there are groups of people out there who rely heavily on one indicator or another. So when I see multiple indicators lining up at a similar pricing range, I know there are going to be multiple groups of traders who are all willing to place bets at that price.
Right.
So for me, I like the 50% line. It's just under 1,800. And I know from an Elliott wave standpoint, there's a couple people you read that are also predicting If we're looking at our A wave in Elliott wave theory, our A wave starting at 1630 and ending around 1960, there's some Elliott wave practitioners who are looking for a potential end of the B wave correction and the beginning of the C wave rise starting somewhere in the same pricing range. So tell me about that.
Well, the Aiden sisters, Pamela and Marianne, have been charting for 30 plus years. Quite good. Their best guess was around 1815. Here's the thing, Miles. We're within 2% of your number, 1.5% to their number.
Sure.
Will that matter in 3 years or 5 years?
2%? Probably not.
Probably not. I've been doing this for 3.5 decades. I go back to what I heard Bernard Baruch quoted as saying, if you can buy within 10% of the bottom and sell within 10% of the top, you're always going to do well.
Yeah, you're beating 80% of everyone else.
Exactly.
So I'll take it.
So would encourage our clients, to get some money set aside, however they're going to invest, whether they want to invest in our vaulted platform or buy product for their retirement accounts or have it delivered to them. Let's get this started, because I don't think we have more than 2 or 3 weeks before this market goes the other way. And world events can change tomorrow. Who knows? I just don't want to be too cute.
So the interesting thing about this Elliott wave theory is there are a set of rules which are worth looking into, but I went through the rules and I went through some of the expectations. Now, again, we're pulling our crystal ball out here, but realistically, there are some good arguments that we could be looking at an end of a B wave retracement right around the same pricing range, give or take $10-20 of where I'm seeing some indicator retracement levels lining up as well. So given some of those Elliott wave rules, I went out and kind of extrapolated out where we could see the next top in gold. Lo and behold, the lowest rise you could see in gold puts us somewhere in around the 2150 mark. And that's the lowest rise you could see based on Elliott wave retracement and ABCD wave pattern principle.
And we're talking 3 to 4 to 5 to 6 months out. We're not talking 3 to 5 years out. We're talking a handful of months.
And while it sounds like a lot of money, we were just there.
Yeah.
So we're talking about, as we've been arguing, going back and retesting and possibly breaching the old highs. We're not that far away. It's not as far as it initially sounds when you're talking $300-400 rises in gold. We just had one.
Yeah. And we're going to be there. And this time, we may not stop there. We could go for a little while. This next move higher could be explosive. The last time you and I were bearish on the price of gold, we had people contacting us upset. What, you guys have turned gold bears now? No, we're not. We're just looking at the pattern, telling people this is probably your best opportunity to buy at these levels for the rest of the year.
Well, I'm convicted, and I think I'm going to go dollar cost average in on this 382 touch today. I think when we get out of here.
Yeah.
On other news across the markets, just because I know we got a little deviated on gold, but I think there's good argument to do so because gold tends to lead the charge. Silver, a little bit deeper retracement than gold. It's already coming into that 50% line. And I would argue if we're going to see this play out in gold in the next couple weeks, we may see silver do it first, too.
Yeah.
We're sitting at an 85-1 ratio, and when you look at the ratio chart, it's just come into some moving averages on the top end. It's very likely you're going to see that ratio come down from 85-1, maybe down at least into the 70s. So I think there's a good chance that as gold continues down here, we hope for the next week or two until we finally find that bottom, you may go ahead and start to see silver begin to rise in anticipation of gold rising.
Boy, that would be a trigger.
Oh, yeah, that would be the telltale.
Yeah.
Now, what makes me nervous on the flip side is the Dow still isn't going up. So I don't know what the Dow's got to do to show a little bit of bullish tendency. We're at the top of this declining wedge pattern, so if we're going to have a breakout in the Dow, it's going to happen in the next couple days. But if we don't see that breakout in the equities market, I think you're looking the Dow drop into 32,000 quickly and possibly below that.
How do you think that'll affect the metals?
Maybe they coincide.
That's what I'm thinking too.
Yeah, if we're expecting the gold price to continue to drop for a couple weeks here until we hit a very near bottom that we're close to, you may see those things coincide. And I think that lines up with the dollar. The dollar needs to get stronger again for a couple weeks. It's unreasonable that it would continue down. And it's good to see the dollar take a little bit of a bump. I'd still like to see the dollar get up to like 107, 108.
Wow.
We're at 104
I was
right
going to
now.
say 103 something. Okay.
Yeah, 103.9
Okay.
while we're talking.
Okay.
So I'd like to see a couple more points on the dollar, but long term, the interest rate rises. We talked about this over the last couple weeks. The dollar's back down to levels it was when the interest rate was multiple points lower, going back to the middle of last year. Now the interest rate is higher. The dollar had that big kind of reactionary boom on the international market. We saw one of the highest dollar DXY values in many, many years. But we're losing ground, even though the interest rate's continuing to go up. So,
Well, that's because they have to print more money to pay the interest on the national debt.
sure. Well, now we're gonna fall back into my biggest complaint, which is interest rate rises where the U.S. government and the Fed's balance sheet don't also play ball.
They're not.
It only negatively affects U.S. citizens.
Yeah.
It's not hurting anybody but us. So this is going to be a really telling spring. And
Yeah.
it may not even take Russia. It may not even take COVID to kick it off.
No.
This may be a natural move.
It's just a financial spring without any outside influences, weather balloons excluded.
So that's going to do it this week. We're going to go ahead and wrap because I've just talked myself into making a dollar cost averaging purchase with some of my clients I know have been sitting in cash. I think it's time to do so today. Give us a buzz if you'd like to talk about your own precious metals portfolio. We appreciate you joining us each week. And if you'd like to talk to Rob, myself, or any of the advisors here at McIlvaney Precious Metals, we can be reached at 800-525-9556. You can find more info on our website, McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks again for joining us and have a great week.